Treasury yields have seen a modest uptick, but they are failing to break through resistance. We saw the big range we've seen in December. We've got that north of 3% down towards 280. Midpoint ends up coming in right around 293, and that's where we sit right now, kind of the middle of that range. Given the fact that we've seen some good data come in, given the fact that we've seen some relief out of Europe with the UK, getting its vote of no confidence and keeping its prime minister on board. And likewise, it looks to me like the market is waiting for something next week at FOMC. So we are drifting back towards the middle of the range. We're not seeing any momentum trade here in Treasury space like we saw previous weeks where we saw the yields go down and touch those recent lows. We're off those and we're kind of waiting for something, that it moment we'll call it. And if you look at market volatility, it's starting to come off. We've been trading with very elevated levels, not only in Treasuries, but also in equities. Obviously the uncertainty and the wider intraday swings have added to that, but we're starting to see vols come off despite the fact that we have some key events coming up and despite the fact that year end's coming. So volatility going lower means we're probably heading back into that old range. And lastly, let's look at the one part of the component here we haven't talked about a whole lot, and that's the curve. 210s has been trading, it's steepened today up to 15. We call that a steepening, but it's really almost down to 14, and you're looking at it getting near zero. This is as close to zero as we've been in a long time. And with the Fed getting ready to raise rates next week, the 2-year note is going to be adversely affected. You're going to see that curve flatten regardless, unless there's some kind of jolt to the back end of the curve, and we see yields rise 25 basis points to keep in lock and toe with 2-year. I think that's going to continue to see a flattening. And now, while they're not saying it's recession, calling for a recession, when you see 2 and 10-year yields flip, it obviously means that those would be willing to hold on to something longer for less, and that's kind of disturbing. And if you look at what's happening in equities, we're seeing these wide intraday swings. We're seeing some big losses. Likewise, we're seeing some mixed trade in Treasuries. The market needs some clarity, and it's probably going to get it from Mr. Powell next week at FOMC. The one thing I don't think it's going to get is him just laying it all out, how things are going to work. I think he's been relying on the economy as his guide, and he's going to continue to do that. But I do believe that the FOMC will be done with rate hikes, at least for the time being, after next week's rate hike, and then they're going to kind of play the waiting game. Might not see another rate hike until the middle or third quarter of next year, if at all. And if we don't, I think that's probably going to be a result of what's happening in Europe, a result of what's happening in lower growth in China, lower growth here, with the idea that maybe the market needs to kind of live in this 2.5 funds rate era for a while after being at zero for 10 years. It needs to kind of live somewhere steady, maybe not the neutral level, maybe not the level the Fed had hoped before, but it's going to be where we're at. And I think right now 10-year yields are doing the same thing. They're waiting for that. What is that it moment going to be? Is 3% going to be the level? Is it going to be 280, or maybe is it going to be higher? And I think right now the market's still getting its sea legs under it. So Treasury yields modestly higher, but still waiting for that it moment. It could be next week at FOMC.